So, Tim, I had to cut you off from a timing perspective. What the punchline is? What do you actually think the leverage? How much leverage is in the loan market these days?
Yeah, I think that if you actually strip out these ad backs and you look through to the numbers, I think that what the so-called first lien market is probably north of 7 times. And when I started back, I mean we've been trading loans now for I don't know well over 20 years. First lien was levered at 1 to 2 times, right? National rational EBITDA run rate. And so you look at this and I actually sat with Moody's and S&P probably I think it was February of 20. I was getting into
Hmm.
this with them, and we're talking about recovery rates, right? Because historically, the loans, true first lien loans, are secured, senior. I mean, really, really, again, good recoveries when they do default. When you look through to these leverage metrics, right? I think the recovery rates are dramatically off. They're not going to recover 70 cents, 75 cents if something slows down.
Hmm.
They're going to recover 30 or 40 cents, right? Now, this is a trigger, Catherine, because the CLO market is a very, very big market, one I've operated in for a long period of time too, and they're levered, right? I mean, these things are 10 times levered, 11 times levered, and when you have a structure that's 10 or 11 times levered with loan positions that are 7 or 8 times levered, let's see a show of hands to say how many people are going to think those deals are going to work, right? They're not,
Okay.
and
So,
so this is the
yeah.
fingers in the dike thing. How do you prevent that? When the underlying is a business, right? And it's like you're going to just create revenue, or you're just going to do debt forgiveness. I mean, then you and I are dinosaurs, and I mean, we're all communists. I mean, I don't know where this ends.
Getting to be a dinosaur, I'll give you that. Me
Totally.
personally,
Yep.
not too much, but anyway. But Tim, we only have a few minutes left. But you're basically saying, watch out. There's a lot of leverage in the system, which people can't quite believe because we've already been through the financial crisis, and we always thought there wouldn't be as much leverage. But I think it's happening in the equity markets, and it has been for years as well. But having said all of this, I'm curious. Two questions. One, is there a certain industry or sector that you think has more leverage, or is it kind of across the board? In other words, which one's going to fall first? And then where would you be investing? And you have been an energy investor for a long time. So I've only got about 2 minutes, but what can you tell us in that time?
Sure. Your point is a good one. I think the leverage that we're talking about in the credit markets is pretty broad, in that regard. But when you look at it and you start to peel back, I think healthcare was massively over levered. Technology, a lot of these software, et cetera. So things with no hard assets at all, those become vapor, right? If you miss on those things
Okay.
and you have to restructure those things, what are you restructuring, right? So I think those areas are of big concern that have to be kind of vetted, and they're also creating opportunities, right? If you're actually going to dig through and actually do deep dives in these companies. Let's switch gears real quick, and then we'll talk about the energy markets too, because
Yeah.
we've done that for a long period of time. Stay long production, right? I mean, I look at this stuff, and I think gas is now obviously front and center. You're seeing this arbitrage issue, and really this is a fascinating political issue, Catherine, because I mean, I look at it going, when, because it's going to happen, right? When do we start to think about legislating non-exports, right? Where the U.S. now has $10 gas at the Henry Hub, 9.50, whatever it is today, and that may be going higher, right? I mean, Europe is 80. I don't know how you run a world at $80 gas, and Asia 65. So this is a kind of a natural global arbitrage. That market is strong. There are some data points also in the U.S. that some of this production, particularly from the Marcellus, could be rolling over. At a kind of a granular reservoir basis. So I think that this is coming next, right? And this is the challenge of the politics of the world, is why would you be exporting this product? I think we're with Freeport back online, we're about 12 and a half BCF a day, right? Why would you be doing that and punishing your own citizens with these massive costs, right? So I see this energy market as going nowhere but higher, and it's going to be a structural problem. And in this is super important. In
Yeah.
2007, when shale started kicking in mass, on the oil side, right? Now gas too, but you really have had up until really this year, you've had it's been a demand story, right? There's just been a thought process that you can just turn this stuff on and off at will. And for the first time in that period of time, we are now a supply story. And you're seeing it in the OPEC data, you're seeing it in all this stuff. That
Yeah.
isn't going to change. And this is a
Yeah.
problem, right? So back to the issues, energy's high, staying high, and it's not going, that's structural. Raise rates all you want, right? In terms of this stuff, that's not going to change the supply narrative. And labor is going to remain a significant problem and a structural headwind for margins, right? So if you get the top line going down and your costs going up, this is recipe for massive, compression from a profits perspective.
Yeah. Okay, Tim, we got to leave it there. So much information and even so much more to discuss. Thank you so much for being with us.
Great to be with you guys. Look forward to the next chat.
Thank you. Thanks, everybody.